Last quarter, my team and I looked at dozens of multifamily apartment building deals. We ran the numbers, toured the properties, and took 6 of them into serious underwriting. And we walked away from every single one. In a world where everyone's chasing the next big deal, sometimes saying no is the hardest part of our job. But today I'm gonna pull back the curtain on our private REIT and show you exactly why we rejected these deals. If you're an investor, these 6 red flags are gonna be the difference between a high-performing portfolio and a capital loss disaster. Number 1, the pre-baked upside. The first reason we walked, the upside was already gone. Foundation Capital Private Real Estate Trust, we look for value-add properties, buildings where we can renovate the units and bring them up to market rents. But lately, we've been seeing sellers pricing in buildings based on the units being rented out at market rates and what the future potential of the building could be, rather than what it's actually worth right now with the current rents as is. You should never be asked to pay for the work you haven't done yet. If the value add is already baked into the price, you're taking on execution risk for no reward. Our fund, we buy on the as-is reality, not on the future-based dreams. Second, we saw a lot of lipstick on the pig. Our fund, we're fine with big renovation budgets and taking on significant capital expenditures as long as the price reflects it. On multiple inspections this quarter, we found lots of deferred maintenance. Again, which isn't a problem for us to take on as long as the price reflects it. When we asked for price adjustments to reflect the true all-in cost, including performing these capital expenditures, the sellers blinked. The lesson, if your cost basis doesn't leave room for strong risk-adjusted returns after the significant capital expenditures have been done, the deal was dead from the get-go. Point number 3, betting on the market. Hope just simply isn't a strategy. This is a big one. We saw several deals that only worked if you assumed that interest rates would come down or cap rates would compress over the next few years. At our REIT, we don't underwrite to market optimism. We believe that return should come from net operating income growth that we can control. This is done by us getting turnovers on the units, renovating them, and bringing them up to market rent, not optimism and just hoping and praying. So if a deal requires the global economy to improve just for it to work, that's a deal that we're not interested in. Number 4, the stalled NOI. Some of the buildings we saw were already running at 95% efficiency. They were stabilized. Now, for some investors, that's fine. There's a lot of funds out there that just hold stabilized buildings and yield a return between 3 to 6%. But for our fund, if there's no room to grow the net operating income, that deal is not for us. Our fund targets an annual return of 15% plus, comprising of a 7% cash flow distribution, and we target at least 8% in the appreciation in your unit value. This is achieved by going in, getting turnovers, and improving the value of the building in order to generate that return. Therefore, stabilized assets that don't have room for us to have that rent growth and improve the value of the building simply don't meet our investment criteria. Remember, management alone doesn't generate these types of returns. Improvement does. Point 5, thin margins and the fragility test. We stress test every deal. We ask, what if renovations take 5 to 6 months longer? What if vacancy were to tick up by 2%? On deals we passed, the margins were so thin that a sneeze in the market would give the whole project a cold. When we underwrite a deal, we build in buffers, deep reserves, and contingencies. Resilience matters more than spreadsheet projections. Point number 6, the last cycle anchor. Finally, some sellers are still stuck in 2021. They're anchored to prices from a low interest rate environment that no longer exists. We aren't in a rush to overpay for something just to complete an acquisition and say we bought something. This is a great equalizer, and we're happy to stay patient until pricing matches the realities of today's financing environment. Passing on a deal isn't exciting. It doesn't make for a flashy headline, but preserving our investors' capital is our first, middle, and last priority. We aren't inactive, we're very intentional. We deploy capital into deals when they meet our thresholds and can generate a strong return for our investors, not just because the quarter is ending. If you're interested in learning more about our private REIT, Foundation Capital Private Real Estate Trust, click the links in the description. You can either book a call or reach out to us directly for more information. Thanks for watching, guys, and remember, stay disciplined.